Good afternoon, everyone, and welcome to the review of the S32, S33 rate model review. My name is Philip Germain. I'm the Vice President of Prevention and Employer Services at the Saskatchewan Workers' Compensation Board. It's my pleasure to be here with you today. The agenda for today's presentation will start off with an introduction, and we'll get into the rate model process and focus in on the industry premium rates, an overview of the rate model, and review the transition from the old model to the revised and updated model. And then we'll talk about next steps. I also want to take a minute to set expectations regarding the information that you'll receive from today's presentation. We will not be giving you the 2019 premium rate today. We will show you a comparison of your 2018 premium rate under the old model and under the enhanced model, and some information of what is driving the differences. This will give you an idea of what to expect in 2019 when the transition is removed. We are providing this information to give employers and industry the opportunity to plan and prepare for potential premium rate increases. We've scheduled about an hour for the presentation, another hour for questions if needed. For questions for those online, you can submit your questions at askwcb@wcbsas.com. For those that are here and would like to ask a question, if you could use the mic so that people online can hear your question and my response. So what do your premiums cover? Why do you pay premiums? As employers, you fund the compensation system and are protected from being sued if there is a workplace injury. The premiums you pay ensure that your workers are protected if they are injured on the job. They'll receive wage loss benefits, medical, and rehabilitation benefits. The main objectives of the rate setting process are to ensure that the overall premium requirements for the WCB for the coming year are met. Premiums should cover all current and future costs for the claims from employers operating during the year. So we'll cover, again, workers' compensation / wage loss payments, vocational rehabilitation benefits, healthcare costs, survivor benefits, the administration of the program, and the cost of safety associations for those industries that actually have safety associations. The rate model setting process should ensure that the distribution of the revenue requirements across all employers is equitable. While maintaining collective liability, it should promote accountability and fairness and recognize injury prevention and disability management practices. It's important to note that there are two key components that factor into the calculation of premium rates: claims costs and payroll. The costs associated with workplace injuries that have occurred in the past help us project what future claims costs will be. The second key component that drives the premium rate is employer payroll. Payroll is collected for all workers in all industries, subject to coverage under the Workers' Compensation Act. Premium rates are set based on the ratio of claims cost to payroll. It's important to note that WCB is funded by the premiums employers pay and the investment income earned from those premiums. Premiums that we collect in a year cover all costs for all claims that happen in that year. So if a 15-year-old suffers a severe injury, we will collect enough in 2018 to pay for the lifetime costs of that claim. An actuarial model is used to predict claims costs for the upcoming year. Actuarial models ensure financial stability and security of benefits for injured workers. Costs include an industry's own claim costs, as well as their portion of shared costs, which is the collective liability aspect of the WCB system, which is really, at the end of the day, an insurance program. Industry premium rates are simply costs divided by payroll. This slide shows the timeline of events that brings us here today. So back in 2015, the WCB conducted what was called an asset liability study through an external consultant called Eckler. This study incorporated actuarial asset liability and investment return projections, and in there they made a recommendation that WCB should review its rate setting model and funding policy. So in 2016, as a result of the recommendations in the asset liability study, a review of the rate model was completed by the external actuary. They provided us a report in September of 2016, and then in October, we introduced the enhanced model to all stakeholders during the rate setting meetings. In November and December of 2016, we conducted province-wide education sessions to educate employers about the enhanced model. In early 2017, we conducted industry rate employer education sessions that included information about the potential impact of those changes. And we consulted with employers on how to transition to the enhanced model. In October, we shared the information on the 2018 premium rates and the plan for transition to the enhanced rate model. January of 2018, the enhanced rate model became effective, and February this year, right now we're going through a series of sessions to help update rate codes that will likely see their premium rates go up in 2019. So the principles, there are key principles that guide the rate model. The premium rate setting process should be appropriately balanced. We should appropriately balance these sometimes competing principles. The rate model should be robust and sustainable, satisfying the needs, goals, and expectations of employers while being actuarially sound, relatively simple and easy to understand, communicate, and administer, and provide for the security of benefits for injured workers. So the first two competing principles are collective liability and accountability. When we think about accountability, the premiums paid by current employers should cover the costs of their injured workers during that premium period. This principle covers something called intergenerational equity, meaning current employers should not be paying for costs generated by past employers, nor should they be subsidizing the claims costs of future employers. And it covers intragenerational equity, meaning employers that incur injuries should be responsible for the costs associated with those injuries. A fair rate-making model encourages workplace safety and effective return-to-work policies by financially incentivizing employers towards those positive behaviors. The counterbalance to accountability is collective liability. Employers as a group and those within the same industry are jointly responsible for all workers' compensation costs. Also, employers should not be excessively punished for unusually costly claims. Thus, portions of unusually high-cost claims should be shared by all employers. The other two competing principles are rate stability and reactivity. Employers should rely on a level of predictability and stability within the rates. Employers typically don't want their premium rates bouncing up and down significantly from one year to the next. On the other side of that is reactivity. Industry should expect quicker recognition of successful prevention initiatives and claims management processes. It should be quick to recognize industries with poor safety performance as well. The model should be transparent and fairly easy to understand. Employers should be able to understand the factors that went into setting their premiums, and the WCB should be able to clearly communicate this information to employers. So if you think about insuring your own vehicle or your house, so if you have a vehicle, you are pooled with other similar types, people who own similar types of vehicles. You pay the same basic rate of insurance, unless you have more accidents, costs then you're going to pay more. Or you're engaged in high-risk behaviors, then you're going to pay more. So those that use the system more will end up paying more. Now, having said that, if for any number of reasons your vehicle is totaled, it gets stoled, damaged, destroyed, you're not going to be responsible for replacing the cost of that vehicle, the costs associated with replacing that vehicle. The insurance program, the collective liability, all employers share in replacing that vehicle and the costs associated with replacing that vehicle. WCB as an insurance program works the same way. All employers share in the costs. We try to hold employers and industries more accountable for the costs that they incur within the system. We try to stabilize the rates so they're not bouncing up and down. But at the same time, if those that have better performance, should see their premium rates go down. Those that have worse performance should see their premium rates go up. So quick overview. For those that have not seen any of the previous presentations, this is going to be a quick overview of the components of the enhanced model. We do have a white paper online on the WCB website that provides a comprehensive overview of the model. As well, there are recorded sessions of education sessions of the rate model that are available on our YouTube site. So at its highest level, the key drivers of premiums are still claims, costs, and payroll. The enhanced model changes the way we estimate those costs for the upcoming year. So we're not looking for more premiums. What we're trying to do is figure out a fair way of distributing those costs based on each industry's experience. The following 6 components impact industry premium rates under the enhanced model. And the first component is credibility of industries. Credibility is the extent to which you can use past experience to predict future experience. Under the current classification structure, there are a number of smaller industry rate codes with lower credibility, making it difficult to predict claims experience. And S32 and S33 have typically lower credibility. There's just not enough claims experience to be able to accurately predict future experience. So there's different ways that we've went about trying to do that in a fair way. The change for rate codes that are not fully credible, their experience should be complemented with a longer experience period. So in the old model, if you were a low credibility rate code, we take your experience and blend it with the experience of all rate codes. So at the provincial, at the all class level, at the board level. We'd blend those two to try and get enough experience to be able to predict costs going forward. We changed that in the new model in that we collect a longer period of your experience. So if within 5 years, if we don't have enough experience to accurately predict going forward, we'll look at a 10-year window, pull in 10 years of your experience to try and predict use the past experience to predict the future experience. So what does this mean? This adjusts credibility to use more of an industry's, their own experience. So we're holding industry more accountable for their own experience. We're not blending it with the provincial average. And to achieve a reasonable balance between reflecting recent experience and reducing volatility for smaller rate codes. Because the more information we have, the more accurately we can predict going forward. If we're not predicting accurately going forward, you could see your premium rates bouncing up and down because we're just not able to accurately predict where your premium rates and costs are going to go. An example is if 5 years of cost history, so if your rate code was 80% credible, we'd use 80% of the first 5 years experience and 20% of the 10-year experience. Blend those together to come up with a prediction of what your costs might look like going forward. The second indicator is the use of, the second one is the use of indicators to predict costs. So the second component of the enhanced model is the way we use indicators to predict costs. Under the old model, we projected the number of time loss claims and the expected future costs associated with those claims. The concern with this method is that while the number of claims have been declining, there has not been a proportional decline in costs, particularly when it comes to long-term claims. So for a long time, there was a strong correlation between reducing time loss claims and reducing costs. Over the last few years, that hasn't been the case. Time loss injuries are dropping much faster than costs. So it's no longer a good predictor. So the change that we made was to use something called the evolution of workforce, not the number of time loss claims to determine future claims costs. The evolution of workforce considers the change in the number of insured workers in the rate year to estimate future costs. So if it looks like you're going to have more workers in the industry, then we're anticipating more costs. If you're going to have fewer workers in the industry, we would anticipate lower costs. This change increases rate stability and improves the ease of understanding, makes it easier to understand why your premium costs might be going up or down. And again, so with the change, it's as simple as if we're predicting more workers in the industry, we can predict more costs. If we're predicting fewer workers in the industry, we can predict lower costs. The third component is something called costly claims pooling. Cost pooling is when costs are spread amongst a larger group of employers. For example, certain costs may be allocated at a rate code level or amongst all employers in the system. This increases collective liability so that a group of employers are not unfairly burdened. Under the old model, pooled pension costs, we only pooled pension costs above $90,000, and we only pooled them at the class level. So the S code or the S class, so there's a number of rate codes, S rate codes in the S class. We would only pool pension costs above $90,000 at the S class level. We'd redistribute those costs based on a percentage of your payroll within that class. The change is we've applied pooling at 3 times the ultimate maximum wage rate as a better balance between industries being accountable for their own claims and collective liability for rare, high-cost injuries. So what we're doing is costs in excess of 3 times the ultimate maximum wage rate at WCB, which is around $252,000. So 3 years of the maximum wage rate equals about $252,000. Each employer or rate code, the first $252,000 will stay within that rate code. We pool all costs above that, and then redistribute those pooled costs back to the industry based on your proportion of costs in the whole system. So this change increases collective liability, improves predictability, and increases transparency. So you can actually show where the money is going, where the costs are going, and how they're being redistributed either back into your rate code. The fourth component is something called allocation of fatality costs. The old model averaged the cost of fatalities and then allocated those costs equally to all rate codes based on a 10-year average. The change that we made is that all costs from fatalities will be charged to the rate code in which they occurred and then treated like every other claim subject to the claims cost cap. What this means is increased fairness and accountability. Those rate codes and those employers that are having fatalities will be held more accountable for those fatalities and the costs associated with those fatalities. The fifth component of the model is long-term claims. When projecting future costs, the old model considered costs paid during the past 5 years for claims that occurred over 50 years. So if there was a claim that had occurred 50 years ago and we're still incurring costs today or within that window, the 5-year window, we would pick up all costs for any claims that happened over the last 50 years. So any costs that we received within the last 5 years, but it could be for a claim that happened 50 years ago. Somebody maybe needed a replacement of a prosthetic. So if we had that cost within that 5-year window, even though that claim happened 50 years ago, we'd capture those costs. The change that we made is to apply all costs for the first 7 years of a claim to the industry experience. Any remaining costs are pooled at the board level and then allocated back to industries based on the industry's proportion of costs in the system. So what this means is increased reactivity by putting an emphasis on an industry's most recent costs. Increased accountability for industries because of their most recent experience, and increased collective liability for old claims costs because now we're pooling all costs that are over the 7 years, that are more than 7 years old. The final component of the rate model is the allocation of administration costs. And the change that we made here was we increased the fixed component of administration costs from 10 to 30%. So our administration costs are relatively the same from year to year. And our administration costs are kind of broken into two pools, fixed and variable. The fixed costs are the things that every employer will share in, regardless of whether you've had claims. Our human resources, our IT, every employer needs to register with us, every employer needs to pay premiums, assess their payroll. Those are all things that all employers either share the cost in and or are engaged in every year. Those are our fixed costs. And they're roughly 30% of our overall administration costs. The other costs are variable, and they are the salaries associated with us administering claims, dealing with claims. So in the old model, we had a ratio of 10% fixed, 90% variable. That's actually not the way our administration costs broke out. They were more 30% fixed, 70% variable. So we simply reallocated that and then applied that to each rate code accordingly. So the enhanced model was implemented for 2018 after customer consultation. The board decided to, so after customer consultation, the board decided to transition the impacts for those whose premium rate would increase under the enhanced model, but for 2018 only. The move to the enhanced model means that 14 rate codes would see increases as a result of the changes, 14 out of 50. There's a couple that had no change, a bunch that saw their premium rates go down, and 14 saw their premium rates increase. To mitigate the impact of those increases, WCB drew from the injury fund to cover the costs associated with the transition. But again, this was for 2018 only. The board's funding from the injury fund covered the cost difference between what an employer would have paid in 2018 with the enhanced model versus what their final 2018 premium rate was set at. Those industries whose premium rate decreased under the enhanced model had the premium rates calculated under the enhanced model for 2018. So for rate codes that were seeing their premium rates go down, they saw the full impact of that change. Now when we transitioned, we did it in two ways to try and balance out the needs of industry in understanding and dealing with these changes. So this slide shows the two examples of how rate codes were transitioned. And the reason for the transition was to give industry and employers time to adjust throughout 2018 to what you could be paying under the enhanced model in 2019. To be considered for a transition, the premium rate under the enhanced model was higher than the 2017 final premium rate. Once a rate code was identified as a transition rate code, their premium rate for 2018 was determined in one of two ways. In the first example, the industry had a $1 premium rate. Under the new enhanced model, it should have gone up to $1.30. We recalculated that premium rate based on The old model, it came out at $1.20. So we transitioned, so we set the premium rate in 2018 at the $1.20 using the old rate model, and then we transitioned the difference between $1.20 and $1.30. So 10 cents were paid out of the fund to cover off that 10 cents. The other way that we dealt with this for some rate codes was, again, the other example, they started off at $1 premium rate. It should have gone up to $1.05. When we looked at the various options, we actually set it at the 2017 premium rate. That was the closest thing that we could get to without charging necessarily the employer, going all the way to the enhanced model. So in the second case, we actually just stuck to the 2017 premium rate. And then we transitioned the 5 cents from the $1 to the $1.05. So there's two ways we did it, trying to identify the best. There was two methods that we used to try and identify the best way to transition each rate code in a fair way as possible. The industry impacts provided in this presentation. So now the next slide, and we're going to talk about the enhanced rate model and the impact of implementing that enhanced rate model on your rate codes. The industry impacts provided in the presentation that I'm going to show you are comparing the 2018 industry premium rates from the old model to the enhanced model. The intent of providing this information is to educate on the model's changes and provide for potential impacts to employers. 2019 premium rates will be developed using the enhanced model and will include updated experience. So you'll drop off a year and we'll add 2017 experience to recalculate your industry experience. Those proposed or preliminary premium rates will be presented in October. It's important as we go forward into the next slides to understand the rate model is a system that balances the principles of collective liability and accountability and reactivity and stability. So all the components are designed to improve collective liability and accountability, reactivity and rate stability. So balancing all those components out. All the components work together to try and determine a fair and equitable premium rate for your rate code as compared to all other rate codes. So let's look at S32 for personal business and leisure services. First component is credibility. Under the old model, this rate code was 56% credible. So we would blend its experience with the board experience to try and increase or improve the credibility of the rate code, our ability to predict future costs for this rate code. That blending often caused an increase in the premium rate for this rate code. Under the enhanced model, this rate code is actually 80% credible. And while the 10-year costs are higher than the 5-year costs, which actually drive up your costs overall, it still ends up being less than the old way we used to define credibility for your rate code. The end result is that there's a penny drop in this part of the premium rate. For change of indicators. So time loss claims have been steadily declining since 2010 in this rate code. This means that under the old model, the reduction in time loss claims caused the rate model to expect a corresponding decrease in claims liabilities or claims costs. But that's not what was actually happening. Even though time loss injury rates were going down, costs were not going down as steeply as the time loss injury rates. So we were really overestimating the decline in costs in the rate code. Using workforce as an indicator will cause the rate model to expect an increase in claims liabilities that is more in line with the steady growth of this rate code. Therefore, the adoption of workforce as an indicator will increase S32's premium rate by a penny for 2018. Claims cost pooling. Under the old model, again, we would pool pension costs over $90,000. That's the only aspect of the costs that we would pool. Average pension costs for S32 were 234% higher than the average S sector costs. So when we pooled the pension costs for S32, the amount you put into that pool was a lot less than you took out, causing it to keep your premium rates down. Moving to 3 times the max, so once a claim hits 3 times the max, we pool everything above that. Costs in excess of 3 times the max are 13% lower than the board average. Therefore, pooling costly claims is going to increase your rate, meaning you're putting in less than what's being allocated back out to you by pooling all those expensive claims. Under fatalities, you'll see that there's no change. So the S32 had 2 fatalities from 2012 to 2016. And the costs associated with those fatalities was roughly the same as the old way that we calculated fatality costs. It just happened to work out the same. So there was no change there. Long-term claims costs. S32 had a smaller portion of costs in the long term. So again, the way we look at long-term claims, first 7 years is assigned to the rate code. The other 43 years of costs are pooled up and then after that, all those costs are pooled, they're redistributed back to the various rate codes based on your proportion of costs in the whole system. What you're putting into the pooled is less than what's being allocated back out. That's what's happening here. That is causing your premium rate for this component to go up 11 cents based on the change from the old way we calculated premium rates to the enhanced model of calculating premium rates. Then the final component was administration. So we switched, if you remember, we switched from 10% fixed and 90% variable to 30% fixed and 70% variable. Making that switch, under the old model, your fixed costs, your costs associated or your premium associated with paying for the fixed costs of our administration were 3.3 cents. Under the new model, it's 9.9 cents. Under variable, however, under the old model, the variable costs, so costs associated with looking after claims, was 27 cents. Under the new model, it goes down to 25.5 cents. The net change there under the old model was 30.3 cents to 35.4 cents. So roughly a 5 cent increase, 6 cent increase there. So this slide shows an illustration of how your premium rate was transitioned. As you can see, the 2017 premium rate for S32 was $1.07. The old model produced a premium rate of $1.05 for 2018, and the enhanced model produced a premium rate of $1.25. The 20-cent difference from the $1.25 and the $1.07 that we ultimately charged you, the 20-cent difference from the old model to the new model, from $1.05 to $1.25, is what we consider transitioning. The final rate we chose was $1.07, so we covered 18 cents of what the 20 cents that should have been increased to the premium rate for 2018 only. We'll talk about next steps after we go S through S33, which is caretaking and park authorities. So we'll go through the same breakdown for caretaking and for S33, and then we'll talk about next steps after that. So for credibility, very similar to S, in some ways S32. The enhanced, under the old model, S33 was 39% credible. So we blended their experience with the board level experience. And in this case, S33's experience was worse than the board average, so blending them actually reduced their premium rate artificially. Under the enhanced model, it's 56% credible. So then now we've got to look at the 10-year, the 5 and 10-year average. And again, the 10-year costs are higher than the 5-year costs, which again increases your costs under this model. So your more recent experience is better, but there's not enough cost information to accurately predict going forward. There's not enough credibility. So we look at a 10-year window versus just a 5-year window. And because the 10-year window, 10-year costs are higher than the 5-year costs, this is bumping up your premium rate by 2 cents under credibility. For change of indicators, similar to S32, time loss claim counts have been steadily decreasing since 2004 in this rate code. This means that the use of time loss claims caused the rate model to expect a corresponding decrease in claims liability. But cost did not decrease as much as the time loss injury rate. So again, we were overestimating the decrease in costs in this rate code. Using workforce will cause the rate code to expect an increase in claims liabilities that is more in line with the steady growth of this rate code. Therefore, the adoption of workforce as an indicator of costs will increase S33's premium rate by 15 cents. Under claims cost pooling, average pension costs, so the old way we did it was we'd pool pension costs over $90,000, and the average pension costs were 14% higher than the average S sector pension costs. So S33 used to benefit from pension pooling. The costs in excess of 3 times the max are 19% higher than the board average. Therefore, pooling should be 19% lower. Therefore, pooling costly claims will actually increase their premium rate. So again, in that case, this rate code is putting in less into the pooling than what is being allocated back out. Under fatalities, 2 fatalities from 2012 to 2016, and the costs associated with those 2 fatalities more or less happen to be equal to the way we used to calculate the cost of fatalities in the past. So no change there. Under long-term claims, S33 receives a smaller portion of the pooled costs. So what they're putting in is greater than what they're pulling out, which is going to cause their premium rate to decrease by 19 cents. So their long-term older costs are quite high compared to other industries. So they're putting more in there, and then the reallocated amount is less, causing your premium rate to actually go down by 19 cents for this component. And then under administration costs, Again, the fixed component is going from 3.3 cents in the old model to 9.9 cents in the new model. The variable costs, those costs associated with administering claims, will go from 25.7 cents under the old model to 24 cents under the new model. The net change there is you're going from 29 cents to 33.9 cents, roughly a 5-cent change. So again, this slide is illustrating how your premium rate was transitioned in 2018. You can see the 2017 premium rate for S33 was $1.05. The old model produced a rate of 99 cents for 2018, and the enhanced model produced a rate of $1.18. The 19-cent difference is what we just went through in looking at each one of those components. The final rate for 2018 was $1.05, as we held the rate at the 2017 level as part of the transition. This means that 13 cents was covered by the injury fund for 2018. So what does this all mean going forward? So if all things stay equal, your 2019 premium rate would increase under S32 to $1.25 and S33 to $1.18. But in order for that to happen, the claims costs and payroll for all industries would have to remain the same, which is not likely. The 2019 premium rate is dependent on more than just your industry's experience and payroll. If the board's overall experience worsens while your industry experience improves, in theory, the industry could still see an increase because of the pooling that's applied for costly claims and long-term costs. In addition, the industry share of risk will be dependent on their ratio of costs compared to the overall costs. So there's a number of factors there. The biggest factor, though, is your own experience. The updated experience for your industry and other industries will determine the degree of change that you'll see in 2019. So that number could go up, could go down, depending on your experience. So today's presentation is recorded and will be available on our website for the next few days. After that, it'll be on the WorkSafe or the WCB's YouTube website. As you review the information presented today, you may have more questions. Some of this stuff could take a few days to absorb. You may think of something in the next few days or weeks. You can, if you do, you can submit a question to us at askwcb@wcbsas.com. And for those that are online, you can submit questions now at askwcb@wcbsas.com and or use the same email address to ask us questions later. There are resources, like I said, on the website, on the WCB website. There's a white paper that provides a comprehensive overview of the model itself. On our YouTube channel, there are a number of education sessions that talk again about the model more in depth. This overview today was not intended to give you an in-depth overview of the model. Those resources are available. Today was to talk about how your rate was transitioned in 2018 and why, and what it might look like in 2019. At the end of the day, if you're looking at some of these resources and you still have questions, don't hesitate to email us or even call us. And people like John Wagle here, he can meet and or find somebody who could meet with you to discuss any other questions that you may have if what we're presenting or providing to you is just not quite making sense. Reminder that your 2019 preliminary premium rate will be available in October during our rate setting meetings. At the end of the day, it's important that you can influence your premium rates. The ultimate goal is mission zero. Zero injuries, zero fatalities, and zero suffering. Injury prevention really is the best way to minimize costs and human suffering. The easiest claim to manage, the easiest claim to deal with is the one that never happens. Having appropriate safety programs in your workplace can be an effective tool to preventing injuries. Having appropriate return to work programs can help minimize costs and influence premium rates positively. There are resources available for some industries. There are safety associations that are available to help out. There are people like John, account managers. We have several account managers at WCB that can answer questions and provide some advice. The WorkSafe website has online training, online resources, as well. WorkSafe offers some classroom training. All of these resources are intended to help employers deal with preventing injuries and or more effectively managing claims. So I want to thank you for your attention to this important information. This brings our formal presentation to a close, and we'll now open the session to questions. Just a reminder for those online that you can use askwcb@wcbsas.com to submit questions. First question. And just a reminder that if you do have a question, please use the mic so that the people online can hear your question and my response. Anything online? No? Okay. Anybody formulating a question that they just want to think about? If not, we'll be here. We'll be around after the presentation if there's something specific that you'd like to talk to us about that might not be related to this, and or if you're not even sure of the question but just want to talk about it. Again, for those online, we encourage you that if you think it's something after, please submit the question, and we'll get back to you usually within 5 business days or a typical work week. And if there are no questions, then I want to thank everyone for attending